Good morning and welcome, folks. My name is Robert Coulter. I'm the General Manager for Partnerships here at the AFA, and it's my pleasure to introduce today's session. A session, Not All Bonds Are Equal, not even government or corporate bonds. We're talking about the certainty of insurance bonds. There is a renaissance underway in financial planning strategies and bonds. Advisors are revisiting the role of bonds in financial advice, and for good reason too. Can you afford to ignore them? This webinar, in consultation with Centuria Life, examines strategies for wealth accumulation alternatives outside superannuation to estate planning certainty. With over 5.5 million Australians moving through retirement and the intergenerational transfer of wealth, it makes for a relevant and timely webinar topic. Today I'm joined by James Jarvis. James has worked for 25 years in wealth, investment sales and relationship management. He began his career as a funds analyst, gaining 12 years operational experience at a national dealer group. He made the move to funds management in 2007. He worked with Colonial First State, Guardia Capital and ABN AMRO Morgans before establishing his own consulting business in 2014 to work with a panel of boutique fund managers in equities, fixed interest, property and property. James is married with 3 children. He lives in Brisbane and he joined Centuria in December 2019 as distribution manager for Queensland. Before I hand over to James, there are a couple of things that I want to bring to your attention from a housekeeping perspective. Today's webinar has 1 CPD hour available and we'll send those certificates out to you within the next week. James will answer questions at the end of the presentation. So if you want to ask a question, please use the Zoom Q&A feature, not the chat feature, as you can see in the diagram in the slide. I'll be back towards the end of the webinar to assist James with those Q&As. I've personally been looking forward to this webinar. We've had a significant amount of interest in this area, so I'm sure James's insights as he explores these real-life case studies will be extremely valuable. James, welcome. Thank you very much for putting this important information together to help our members. James, welcome and over to you.
Well, thanks, Rob, and good morning. Let me also add my own welcome to you all, wherever you are taking this call in and this AFA Centuria webinar. I trust you're safe and well. Some of you, no doubt, still working from home with the COVID-19 conditions, but many of us now starting to return to the office for some business as usual. It's been anything but usual, I'm sure you'd agree. And as we approach the end of the financial year, thank you very much indeed for your time at a busy time of year in these extraordinary circumstances. For those of you who we do know well, thank you for your support. And there's a number of advisors we know in the call today with whom we've been working. But for those of you who are meeting us for the first time, thank you and welcome. We're looking forward to making a connection with you through this webinar. So not all bonds are clearly the same, and in our industry, that is the same. There is only one 007, but there are many bonds. And as was alluded to in the introduction, we've got a lot of different types of bonds: sovereign bonds, corporate bonds of different credit quality. The term that one's word is one's bond. All of those things get thrown around in our industry. We're talking about insurance bonds today because when we look at the amount invested in superannuation, there's some $3 trillion invested in superannuation today. Very successful long-term savings platform. Bonds, insurance bonds, less than $10 billion invested, and great opportunity to grow that segment of the market. And as Rob alluded to, we've got very significant numbers of Australians, 5.5 million Australians now in retirement or moving through into retirement. And I'm sure you'd agree that the changes to superannuation with the transfer balance caps and the concessional components in 2017 was a major change in superannuation. So those are the reasons we want to talk about why bonds are back. And we're going to do this in 3 parts. In the next 20, 30 minutes, I'm going to try and speak for about 30 minutes and then pull it up for some Q&A. And the idea is that we'll talk about why bonds are back. We'll then talk about a couple of case studies just to throw it into sharper focus for you. and then from there we'll come home and talk a little bit about working together. I want to introduce Lift to you, which is a forecasting tool, and if you take nothing away from this this webinar, take away the opportunity to go and have a look at how this calculator can work in your business with your clients to illustrate the role of a bond in a strategy or two. What's in it for you is probably just a recap. There are many professionals in the network who will know a lot about bonds, for some rediscovering some of the features of insurance bonds. And what's in it for us is really just to shine a light on what's happening in this segment of the marketplace, with a view to encouraging you to maybe take your clients for a bit of a test drive in some of the strategies we're talking about using the bond. Before we talk a little bit about Centuria, before we talk a bit about bonds, let me just tell you a bit about Centuria. So we've been in the business for over 40 years in the investment bond business, but we're a bond and we're also an investment property, commercial property funds management house. So we have about $7 billion of assets under management, and with a further acquisition that's been announced on the stock exchange, the successful completion of that would take us up to around about $9 billion of funds under management. So that's Centuria. We've had a long heritage in bonds and a strong foundation in real estate, commercial real estate funds management too. So why bonds are back? Well, bonds are back because in many respects, superannuation has been a point of significant change. I'm sure you'd agree that when you look at the graph, we look at the picture in front of you, you can plot wherever you come into this industry, whatever year it was, bonds and superannuation have had very different experiences in terms of change. So the frequency and tempo of superannuation change is both a blessing and a curse. A blessing in one sense because you've been able to take complex subject matter and changes to your clients and turn them into more simple and compelling opportunities. But a curse because with complexity comes uncertainty. And so in contrast, the bond, the insurance bond, has a long history of very stable rules and benefits and legislation. And that's an important feature of why bonds, we think, are back in focus because of their simplicity. When I think about the savings vehicles in Australia, I came into the industry at the very start of superannuation with the introduction of SGC in the early 90s. Superannuation and investment bonds are really the bookends, if you will, of the savings platform in Australia. And between that, you can hold assets directly, you can certainly hold assets in a family trust. So when I look at all of those things and start to think about bonds, advisors tell us, are really the best of both worlds. In one sense, you've got something that can be a very simple 30-second telephone or a corridor conversation with a client. They're similar to managed funds in the sense that you can get your money out at any time. You've got tax at 30 cents in the dollar versus your marginal tax rate up to 47 cents in the dollar. And they can be a bit more complex because they've got a life insurance product around them. But then again, you've got the best of both worlds. Liquidity, you've got access to quality managers, and you've also got the certainty and security of a life product. If we just roll on though and then look at some of the rules and the benefits, just to sort of recap on why bond is useful in your business and with your clients. The 30 cents tax rate, of course, is a maximum tax rate. No more than 30 cents in the dollar on earnings at the entity level. And in fact, that actually is reduced by deductions and rebates like franking. The manager fees, that is the fund manager fees within a bond structure, they also have a deduction at that 30 cents in the dollar rate. So think of a wholesale management expense ratio for a manager at 1%. It will come into the bond at 70 basis points. And it's a fabulous way of creating wealth. You create wealth in a very simple way with a bond. It may not be as tax efficient as superannuation at 15 cents in the dollar. Let's agree that superannuation is a fantastic long-term savings vehicle. But then again, you can't access superannuation until 60, 65, or a condition of release, wherever your personal circumstances are, depending on your circumstances. With a bond, you can switch at any time. You can switch at any time with no CGT. Whereas with a managed fund, of course, if you switch out of a bond, switch out of a managed fund, you'll have CGT and transfer costs associated with it. The 125% rule is one that advisors need to be reminded of. And of course, unlike super, there are no restrictions on putting money into a bond. and no maximum balance caps either. You can invest as much money as you like in the first year of a bond's life and put 125% each year thereafter into a bond. And that's a very effective way of growing your wealth, so that in the 9th year of the bond's life, you can make a contribution, and in the 10th year, get all the benefits tax paid without a change to that first year of the original bond. And for long-term savers, the bond becomes a very useful structure because it's one in which the structure is simple and tax effective, and it's transparent. And it's a great thing to have. It has very little paperwork associated with it. So there's no tax to bring to account. All of the tax is brought to account annually at the entity level. Being a life insurance product, there's also the certainty and bankruptcy protection. So the proceeds of a bond do not form part of an estate. Presentation of a death certificate and the proof of a nominated beneficiary, which is held by the life insurance company, results in a payout. No probate, absolute certainty. So a lot of advisors look at the bond as a means of having certainty with estate planning. And with that, there's a feature that perhaps not many of you know, or perhaps some of you know, but it's worth reminding us all that the assignment feature of a bond is one that allows for portability. So funds can be transferred at any time from a bond at no cost, no CGT. So I can sign a form, I can assign it to Rob, who's doing a fabulous job for the AFA, and he takes ownership of the bond with all the features, with the start date of the bond, and there's absolutely no transfer costs in that process, no stamp duty at all. So just summarising the first part of our session here, we think bonds are back in focus because of the complexity in superannuation and the need for a simple, efficient alternative. As I say, just talking about that bookending. The evolution of the bond into a contemporary choice has seen a great refurbishment of the platforms that provide them, but they're more than just a platform. They're a very effective way of doing this wealth creation, and they're very, very simple and transparent structures these days. And we think that putting those things together, it links it to the opportunity for advice. So let's just look at a couple of investor profiles and case studies. What we've been doing at Centuria is working on a number of life goals strategies that we think are real life potential scenarios where a bond could add some value to the advice discussion. Today, we're going to talk about 2 accumulation strategies, and we're also going to talk about 1 retiree as part of that strategy too. However, whilst we're going to look at Jessica, we're going to look at Mark and Sue, and we're going to look at Alana and John, it's worth noting that there are a range of other profiles where a bond will be of some value, and time permits us only to cover these ones today, but we'll be looking at 2, looking at 5, and looking at 6 at the bottom of your screen there. So if we just look at the first case study, let's make an assumption here. We're going to talk about an alternative to superannuation. Let's make an assumption here that this person, Jessica, has enjoyed a windfall. Now that windfall could be the sale of a business, it could be a profitable portfolio, it could be an inheritance. And so they've come to you for advice. We'll assume that Jessica's got $300,000 and is looking for some advice, and we'll make a further assumption that she has exhausted her use of superannuation, both in terms of her pre-tax salary at $25,000 and $100,000 concessional too. So when we look at the contrast between what to do next and an alternative to superannuation, it's useful to throw into focus the comparison on the screen in front of you. So I'll draw your attention to the balance cap, the fact that there are no balance caps in bond. Accessibility, which we've talked about, that ability to access the money at any time, very important as an alternative to superannuation where there are those strict conditions of release. And transfer ownership, which we talked about before, that assignment that you can do. So those are the 3 features that are relevant to this case study for Jessica. And all of what you see on the screen here can be done with the forecasting tool that we've got in the Advisor Access website. So the $200,000 that we're going to put in as a lump sum in the first year, we're going to make an assumption that $500 a month is going to be invested. and we're going to use some assumptions, some return assumptions. The return assumptions we use in the model in the investor forecast tool based on work that we do with nurses. And you can just see a simple compounding of returns after tax, after fees. That's the first case study. If we look at the second case study, we're going to look at a scenario now where we've got a couple in their 40s who are looking at a life goal in their 50s of drawing down some income that's going to be available for them to fund some lifestyle changes in their 50s. They want to travel, young family, they see an opportunity to do all of that in their 50s. And of course, with superannuation, there are restrictions on when you can access super, and we're going to make an assumption here again that there's a windfall. Proceeds from a business, proceeds from a portfolio, inheritance, whatever. So in this scenario, we look at how we can convert the bond accumulated earnings over 10 years into an income stream for that period in this couple's life where they want access to a tax-effective income stream. Think of it in the old days a little bit like a deferred annuity. So we put $250,000 to work. We make some assumptions around contributions and the uplift factor each year on those contributions. We make some assumptions around the return on the portfolio. And you can see there a very simple upward trajectory around the growth. And then at year 10, a drawdown. And the drawdown you can see there is being done at a little over $5,500 a month. Of course, no personal tax to pay on what is already a tax-paid bond. And in fact, just coming back to that second case study, the other thing that strikes me is that it's a very efficient way of putting some capital to work, but leaving the majority of the capital that's deployed in superannuation just kicking down the road, deferring the start of the allocated pension, which will do the heavy lifting in a person's retirement. So that's the other advantage of using this bond strategy as an intermediate income stream before you go to the allocated pension. I said we'd do a third case study and talk about retirement and estate planning and the opportunity to put a legacy, if you like, in place, an endowment, a specialist endowment in favour of family, children, grandchildren. And this is what this case study is about here with a couple from retirees from Sydney and their grandson, who's age 6, Harvey. Now, we included in the last roll of our PDS a child plan, and about 50% of our bond business is child bonds and estate planning like this. If we just look at this diagram, and I'll take you through how the child plan actually works. So with a bond, in the normal bond, the death of the life insured is the death of the bond. As simple as that. Life insured, death of the life insured is the death of the bond. And the proceeds then are paid tax-free or net of tax to the nominated beneficiary. But if you think about that with older Australians as bond owners, it can be a suboptimal sort of outcome, and especially where there's an aging grandparent or there's concerns about the guardian or the trust estate arrangements. So a child plan strengthens the process and gives greater certainty to the wishes of the grandparent in this case. A separate application is required for each child. So if there were 5 grandchildren, putting $10,000 down for each of the grandchildren, you'd have a separate child plan for each of them. The child must be under the age of 16 at the time of the application, and they must be the life insured. They must be the life insured. You can see there on the screen that the vesting age is between 10 and 25 years. It's nominated between 10 and 25 years. And prior to the vesting age, the bond owner, the grandparent, has full control of the investment. The vesting age can be changed at any time. It's completely flexible. And so in the case of 2 scenarios, let's take the first scenario where the bond owner dies. If they die before the vesting age is reached, then the bond is simply held in trust for the beneficiary who, when they reach their vesting age. And if the nominated child were to predecease the bond owner, then the plan simply matures and it's paid out tax-free and with all the tax-free benefits associated with the bond. So when we think about the case studies today, we've just done the 20 odd minutes into the presentation. We've just covered off on a couple of accumulation and one example of using a bond in a retirement / estate planning sense. Again, you can go to the website and use the calculator to do simple projections. You can see here in the case of Harvey, you've got a child plan, putting $10,000 down at 6 years of age, making some assumptions around growth and contributions, and a lovely little nest egg on his 16th birthday, or it could be pushed out to his 25th birthday at a vesting age, and a grandparent might want to push that to 25 to ensure that it was never spent and it was made available to them at a time when they could most use it for formation of a first house or whatever it might be, a gap year, whatever. So you can see the benefits of that and the certainty that with it. And so bonds are an ideal estate planning tool. They, as the screen dot points indicate, they give great certainty and great stability to wishes to ensure that proceeds go to the right people at the right time with no interference. And particularly useful in blended families. I'm sure you'd agree there's a lot of different family formations now and complexity in that. So a bond can help you work through some of the complexities of those family situations to ensure that people's wishes are locked in with flexibility. So as we summarise the end of the second section, it's really bringing together the sort of the bonds and the features that we talked about in the first section, some of these case studies that they can be applied and used. And what I want to do now as we get into the final straight of the presentation is, it's just, again, reaffirm what's in it for you, the opportunity to reacquaint yourself with the role of a bond, and for us, to give you an idea of how you could test drive it with some of your clients in your portfolios. And to again call out the role of the calculator in helping you with that process in your respective practices. If we talk now about just life goals and what the actual platform, and it's more than a platform, is control, transparency, simplicity, and all the benefits of a life insurance structure. So that governance and the security that we talked about a little earlier in the presentation. So the manager lineup's a really important part of our service proposition, and we've looked at many of the insurance bond providers out there. There's not much difference when it comes to fees, and that's partly due to the costs of and the governance benefits associated with life insurance structure. However, the feedback we get from advisors and investors is that manager performance is a critical part of getting good outcomes for our clients. And I'm sure you'd agree that good manager selection is a very important part of getting good outcomes for clients. Over 95% of the menu that we have for our bond is highly recommended or recommended Lonsec Zenith. And we do a lot of work to ensure that we have a best of breed, genuine best of breed menu for advisors to use with their clients. Sure, you'll agree whether you're looking at cost-effective cores like a Vanguard or a simple effective ETF exposure, and we have a geared option with beta shares, a geared equity option. Give you simple, cost-effective core ways of getting exposure to markets and managers. And you can overlay that, if you will, with actively managed satellites. And a number of the names there will be known to you as very successful satellite or core managers in the portfolio. So we think there's sufficient width in the portfolio to ensure that you can get the job done with clients. And we'll have some additional funds coming onto the menu in the next couple of months, and we'll be targeting 30 investment options. So we're currently a little over 22, and we'll be targeting 30 odd investment options. We've got an ESG offering coming. We've got Pendle and Affinity in terms of the ESG space. We're adding PIMCO on the fixed interest side, and Walter Scott, Green Cape and Vanguard are all joining the Australian equities and international equity staple within the menu. At the fund level itself, the bond level itself, we've got a Lonsec recommendation, and we've got a very strong recommendation from Australian ratings as well. So we are really now into the final part of the presentation, thinking about why bonds are back in focus, thinking about some of the applications within an accumulation and a deaccumulation estate planning environment. The question is, well, how can we work together to ensure that you can take this forward as an idea in your practice from this call? We've got a national footprint, national team, so we've got coverage in all major states. And for those of you who don't know us in the field, there's a point of contact for you. Those details will be available post this conference call. And we've got an incredible amount of investment that's gone into building a support platform for you. So I'd encourage you to go and have a look at the Centuria Advisor access area, get a log on for yourself, go in there and have a look at the tools that we've got. So this new advisor tool that we've got is a calculator, very effective to help you plot some outcomes, putting a bond into a plan. And we've got a whole range of other support documents in there, SOA templates and other supporting information. So the next steps really is to encourage you to think about a test drive. It is about education and knowledge, and hopefully today we've been in a position to just remind you a little bit about what we've done with bonds in terms of the delivery, why they have a role to play in our strategies, and most importantly, making sure that we've got a best of breed manager and delivery mechanism to ensure that the job gets done in a cost-effective way with plenty of performance for those clients. So not all bonds are the same, clearly. The investment bond is back, and we thank you very much indeed for your time and the AFA and the opportunity just to shine a light on this part of the market in your practice. And with that delightful image of a classic bond car, I'm going to throw back to you, Rob, and see how we go. So I think we're just on past, yeah?
Perfect. Thank you, James, and I appreciate that. We have got a number of questions. I'll just one sort of blanket question. There will be these slides are available on the AFA site post this session. James, I've got a question here from one of the folk online. So, can you transfer to more than one other investor, i.e., if you have 3 children, can you use the one fund and then transfer a third of the bond to each child at a later date, with the bond continuing?
There's a couple of ways in which that can be done. The question partly goes to the life insurance. So, a bond owner can nominate any natural person as the life insured, and you could have certainly you could have children as life insured. But of course, the most effective way is to make an assignment of that bond at any time. So you can, within the structure of the bond, make specific provisions for percentages of your bond value to go in accordance with your wishes, and those are held by the Life Office as part of the bond application process and can be changed as well.
So there's been a number of questions around the difference with different bond providers. I mean, I don't expect you to make comment on every bond provider out there, but clearly there is a theme running through questions that there are a number. What are the things that you should be looking for? What are the points that people should be considering?
Well, I think what I said before about we have a good look at the bond providers who are out there, and as we've refurbished our own offering with the Life Goals platform, I come back to where we made the point in the presentation around cost and performance. So I think manager selection is such an important part of the process, getting that right, and we think that we've got an excellent sort of best of breed menu approach, which gives sufficient choice for a practitioner to get the performance for that bond. Because if you think about it, if we get good performance on that compounding of tax effective returns over time, we know that the benefits of starting early give you a good long-term number at the end. And so the inputs into that should be about manager performance. And we think that's our point of difference in the field, that we've got an excellent menu. and we'd like to think we've got a national footprint that enables us to deliver good service to advisors in the field too. Everything else, when you strip it away at the product level, there are points of differences that people will talk about. But I think what all of us would agree to in the bond segment, and there's only a handful of us in the bond segment, is we would all agree that we need to improve the education with advisors. As we said at the start, Rob, there's less than $10 billion invested in bonds. There's $3 trillion invested in superannuation, public offer, industry funds, and self-managed. I'm sure we'd all agree that there's an opportunity here to really grow the use of bonds in practice. And so all of us who are participating in the segment would be at one in terms of the education of that.
Well, James, that's exactly, it's about shining a light is what you're doing today. That, is there an alternative? There's a question here. I assume the question is talking about a 10-year bond, but in the event a client holding a bond and then after 5 years passing prematurely, what are the tax implications for that?
It's very simple. I mean, on the production of a death certificate and the nominated beneficiary details which are held, let's assume that the bond owner is the life insured. If the bond owner is the life insured, then they can nominate a beneficiary. Let's assume that that's the case here. Then after 5 years, simply what happens is that the bond is paid out in accordance with the wishes of the bond owner as the life insured. And if the nominated beneficiary is to each of the 3 children in equal proportions, then that's exactly what will happen. And we've been in the business 38 years, and I think the head of the life company, Michael Blake, was saying in a call just last week, every couple of weeks or every couple of months, there'll be some attempt to sort of disturb the arrangements. The beauty of the bond is it's absolutely a white picket fence. It's a white picket fence around the instructions, and there's great certainty to ensure that people's wishes happen in accordance with the way in which they put the bond together. So you just simply get access to it is the short answer, and all tax paid, no further tax to pay.
Well, as you said, it's an insurance contract.
Correct.
The 125% rule, James. So tell me about the implications of investing more than 125%.
It's a good question. We get this often, and it's important that you stay, if you're going to get the full value of the bond, that 125% rule is very simple, but there's a couple of things that advisors need to know. So let's say you're putting in $100,000 in the first year. You can do that. It's unlimited at $125,000, $100,000 in the first year. In the second year, 125%, 125,000. So it just really goes up. It's a factor of 11 if you think about it mathematically. So it's important that you stay within those guidelines for that 125% of the previous year's contribution that you're making. If you are looking to invest more than 125%, that's fine. But what happens is that we just need to ensure that the component that's above that 125% number of that previous year, what we do is we simply just put that into another bond, and it starts again with that date. So it's a very simple process of just staying within the guidelines. The 125% just as a factor, it goes up. What's really important is that people just contribute to their bond each year to ensure that they're able to maintain the benefits of getting that compounding and that dollar cost averaging and growing their wealth.
What type of reporting of the value does the client and the advisor receive?
So our back office is boardroom, and so we have a service called Advisor Serve. Many of the people in the call will be familiar with Advisor Serve. They'll be familiar with using boardroom as part of their connections into listed registries as well as bonds like our own. So that is the source of truth, if you will, for the reporting. And then we've got the X-Plan interfaces as well for advisors who use that. So we've got all the normal electronic connections that enable advisors to get up-to-date reporting on their client holdings.
Great. Another question here is in those scenarios that you put in, you had you were making annual contributions over that 10-year period. Can you opt not to make those annual contributions? So can you?
Yes, you can. You can, Rob. And it's entirely possible that you could put $100,000 or $10,000 into a bond in year one and make no further contributions. Just bearing in mind with the 125% rule, though, you can't you can't put your initial balance down, year 2 do nothing, and year 3 you can't then make an additional contribution. It's important because 125% of 0, which is year 2, is 0. So it's important that you use that 125% rule to at least keep ticking it along, and that's where we see the real value in it. But to answer the question, you don't have to, and you can simply just make that initial contribution and away you go.
Okay, I got a question around direct equity. So you're considering as an organisation including direct equity in the bond?
Yeah, short answer is no. But make no mistakes. I think we're going to see an evolution of the segment in this country. And when I say it's a platform, it is much more than a platform. But if you think about the introduction of the IDPS and wrap account environment in the 90s and the growth of that as a means of managing wealth, bonds are different because they're life insurance contracts. And so we've got the oversight of APRA, and that does have some bearing on the capacity to introduce extra levels of direct equities and other things. But for the moment, we're very much focused on delivering a best of breed manager list to the marketplace. As I said, cost-effective core or active managers who can be used as a satellite, multi-manager, multi-asset class. We think we've got enough within that menu to accommodate the needs of most advisors in the field.
Got a question here around the range of investment returns for the year April or May 2020. I think that's pretty, it would be interesting. I know it's a pretty broad church, but do you have
look, I've got some fantastic news. If you wanted us to throw into very sharp focus some quantitative and qualitative analysis, which we've done on our menu, we did exactly this. I think it's the old saying that, when the tide goes out, people see you swimming without their trunks. And so we've had a fabulous opportunity to do that during this COVID-19 market drawdown. What we've found is when we look at the Sharpe ratios, the information ratios across the panel of funds that we've gone, remembering in the call, the Sharpes and the information ratios give you a per unit of risk and return measure against cash, in the case of a Sharpe, or in the case of a an information ratio. We're very pleased to report that we've had very strong information ratios across our funds and excess return. So we're happy to share. All of that's very transparent information. We think it bears up in terms of the quality of the manager selection. I know it hasn't been an easy time in the market, but that's where that outperformance, that relative outperformance against the peer group becomes such an important part of partnering with the right provider.
Great, thanks, James. A question around, when you talk about the year, do you mean, is that a financial year, a calendar year, or anniversary date?
Yeah, great question. We're getting into some detail now, and I love it. So we've got, what happens is that Rob, the news is, Rob, I'm not going to assign the value of my bond to you as much as I would love to.
You sure?
But when you and I put one aside for the children in our family, what happens is it's on the it's on the year, the date it's made. So if we go away today and we put one on the 25th of June is the start date for the application and settlement. The day that starts, so from the 25th of June to the 25th of June 2021, that's the 12 months in which we can put as much as we like into the bond, and that'll be the year. So it's the anniversary is the anniversary of the policy.
Okay, perfect. And I think this is a similar but related question, re the 125% rule. So is it correct to say that a $10,000 contribution made on the 1st of June 2020 will have until the 31st of May 2022 to make up the 12,500 contribution?
So you've got a 12-month period in which to make, so if I've listened to the question correctly, the question is, how much time do you have in which to make the contribution in the first year? Is that what the question is?
Well, so it's saying that if you have, is it correct to say that you had a 10,000 contribution made on the 1st of June 2020, will you have until the 31st of May 2022 to make the 12.5K contribution, which is part of the 125% rule? So how long thereafter? Is it the way I interpreted, was it 1 year or was it 2 years?
I'll take that offline and double check as to the timeline, but the 125% is based on looking over the shoulder of the past year in terms of the time that you've got in which to make that catch-up contribution. I'm thinking 12 months, but we'll double check and make sure that I haven't misspoken.
Okay, perfect. Got a question here. What is the exemption for income received from bonds under the Commonwealth Seniors Healthcare Card?
Good question. Haven't got a detailed answer for you, so we'll take that one offline and prepare an answer. Okay,
so the person who sent that through, we can we'll capture that. Another question here around SOA templates. Do you provide any assistance with how, from a structuring perspective?
Yeah, so if you are going to test drive this with clients and look at it as a potential engagement with Centuria, I just encourage every advisor just to go on to the Centuria Advisor Access area and go and have a look at the tools that are available. So we've got an SOA template, we've got more information in relation to the different life goals strategies, some of which we've talked about today. There's a suite of information out there. And remind, Rob, all of our listeners today, the investment forecasting tool, which is the tool that's being used to produce all of the graphs that were in the case studies today.
Yeah.
That's a fundamental part of the offer proposition to go alongside the SOA. What we do is we have a calculator which has some simple inputs. All of the inputs which you saw in the case studies today, they can go into the calculator and you can do a comparison which enables you to produce a 7-page appendix that can go inside your full offer document or your record of advice, and we provide that support to advisors in the field to try and streamline the process in taking their advice to clients.
So I've just had a question that's come through. The two questions that we've taken offline, which is the exemption for income received under the Commonwealth Seniors Healthcare Card and the 125% rule. We'll make those available online to the for people who are curious. Read that answer. Just life insured, James. Who can be the life insured in a bond?
Yep. So the life insured, the investor must select a person as the life insured. The bond owner must have a life insured. So there can be certainly more than one life insured. The default option is the bond owner in most cases. It certainly doesn't have to be related to the bond owner. And as I said, in the case of a bond owner who is the life insured, they can then have a nominated beneficiary. So it's reasonably wide in that sense. The important thing is on the death of the last life insured in the policy, that is the trigger point then for the death benefit to be paid out to the nominated beneficiary. And in the case of the child plan, just to circle back to the child plan that we talked about, in the case of a child plan, the child must be the life insured if they're using the child plan option.
Of course. James, I might bring it to a close there and just record my thanks to you and record my thanks to all the people who registered for today's webinar. I think you have ensured that not all bonds are equal, but I think if the objective here was to shine a light on them, which you certainly have. I appreciate the time that you took to put those case studies together. Clearly, you've got a very innovative tool that people can avail themselves of. It's pretty clear that it's pretty clear to me especially when you're going through the rules and benefits. Super is providing significant change. Bonds provide that level of surety with regard to exactly how you use them. I'd like to thank you and the Centuria team for A, agreeing to this, but B, putting together such interesting information. As I said to the folks earlier, that will all be available on the AFA site. Your CPD certificate will be sent out to you later next week for you to receive. It's left for me to thank you, James, for such an entertaining and insightful comments today. I really do appreciate it. I'd like to thank all the AFA colleagues and community who tuned in today. Thank you again for making the time, and I wish you a very good morning. Good morning.
Thanks, Rob. All the best.